Welcome back to Real Estate Mindset and happy Tuesday. $11.1 trillion has disappeared from the stock market in the last 4 days. We have a one big game of manipulation happening right now. Mitch and I are going to do a full deep dive breakdown and tell you guys exactly what happened today and some of the worries we have as well. One thing I also want to point out, guys, is what happened was near a historical reversal in the stock market. Obviously, stocks plummeted. Now, obviously, everyone right now is blaming Trump and the tariffs and all of that type of stuff. And we're going to show you guys otherwise. And a quick update, I did buy silver for you guys that have been following me. I did buy silver yesterday and I did get back from shark fishing this morning. And I do feel my age. I feel completely beat up. But I did want to say hello to everyone watching. I definitely appreciate you guys. You guys are going to get a huge value today. Everything is going to be chaptered at the end of this, guys. Well, first, let me tell you how this is going to work. I'm going to start with a market update, full breakdown on what happened today. And then our second segment is going to be from Mitch. He's going to go over a thesis of what happened and what's really going on so that you guys as mom and pop can figure out what was really happening. Now, again, after that, we're going to take questions. We're going to give you guys some answers and all of that type of stuff. But let me just real quick say good morning. Good morning. I'm used to doing morning lives. Good evening, like Count Dracula. P Nice, I love you. I absolutely love your profile picture. Dean, Les, Chris, there's Danny right there. Danny, I hope you're going to be a moderator. I know you responded to my email. I haven't responded back yet. Real Estate Watchman Sean, I'm proud of you for all the work you've been doing, fighting corruption with the PPP loans, AirDNA or Airbnb, all of that type of stuff. Definitely love you guys. There's my man, Johnny. This is my buddy right here who's right. Johnny, you're always right. Good job, buddy. So they're starting to understand a little bit, 110% tariffs. But what if the reason why the market went down is because China wanted to manipulate their currency to pay off their debts? You guys ever think about that? It's definitely possible. But Mitch, I'm going to go into the market update, but can you give the viewers a few words? You want to say hello or anything before I go off for 15 minutes on a tangent?
This presentation is going to be very interesting to get through because it's going to drive a freight train right over the press, and it's going to explain what's going on at the Federal Reserve, and that our Federal Reserve is a central bank, but China also has a central bank, as does the European Union, which is the IMF and the European Union itself. And these central banks, as we'll see very shortly, are creating kabuki theater, and because of their actions, stealing money. Not do they just print it, but they steal it to cover off what the problems are that they have created. And that actually ties right back to the central appraisal districts. They're a mirror image of criminality. They're doing the exact same thing, and we're going to go through it and show you how it's done.
Yes, that's also Mitch's way in saying he loves you. Thank you for joining us and hope you're doing okay. Team Mom and Pop. Both of us, Team Mom and Pop. All right, you guys, let's get started right now. I'm going to start with the market update. All right, so as you guys know that have been watching the market shot up about 1,400 points, I believe. The Dow did. It all ended up down because the market is aware that it's incredibly toxic. I mean, seriously, a wrong sneeze and the whole thing comes apart. But just to give you guys the numbers here, the Dow is down 319. Again, this is after a massive rally. The reversal is almost historical. Oh my God. I'm going to get to the super chat here in a minute. I really appreciate your support. Note it, but I'm going to get back to that. Dow down 319, S&P down 79, NASDAQ 335 points. Now take a look at this, guys. Here's the big one right here. Chinese yuan offshore versus US dollar is at a historical low. And that's the premise. Well, I wonder if China's doing this on purpose so that they can devalue their currency to pay off their debt. But this is a primary reason, which you guys are seeing on your screen right here. This is the data to take a look at. This is a primary reason on why the reversal today. Let's keep going. Look at this, guys. Crude oil. Crude oil ended and closed about $58. I'm sorry, about about 4:38 p.m. is at $58.32 a barrel. That's actually really, really astonishing. It actually dropped almost into the 57s. I think it hit about 58.0 and then bounced back up. You see that right here about an hour ago. But either way, oil is plummeting. That's very astonishing. Now take a look at this. This has been a roller coaster ride with the VIX. The volatility index actually ended up 11.39%, and it started way down today, you guys. It was in the low 36, back up to 52.33. This is the volatility, a gauge of volatility. And just to let you guys know, over the last 5 days alone, just 5 days, the VIX, the volatility index, has gone up 140%. Some people still think that we're not in recession. We're not going to have a recession, Mitch. That's kind of funny. But regardless, you guys, the 3-month for the VIX is up 193%. Keep your eye on that. That's going to tell you that the market is really in trouble. Let's keep going. The 10-year Treasury skyrocketed up as well. Everything reversed today, you guys, right before intraday. But this was actually down. The 10-year dropped today to about 4.1-ish, low 4.1s, but it shot up to almost 4.3. Look at this just for a second. Just try to wrap your mind around how much money it takes and how much liquidity drain it has been impacting the bond market. This is absolutely crazy. It's at 4.3. This was just under 4%, guys. Absolutely wild. But the 10-year is up. That affects mortgage rates. And here's what I mean by mortgage rates skyrocket. This is what I mean, because people are like, oh, mortgage rates didn't skyrocket. They've been higher. Well, the last 2 days have actually been skyrocketing, and that you can see in that blue line right there. So mortgage rates have been skyrocketing, which is an indicator that the Federal Reserve, doesn't really control residential mortgage rates. Okay, people selling the bonds and selling the treasuries kind of do. Let's keep going, you guys. Now, here's the interest rates for today. This updated showing interest rates only went up 0.03% or 3 basis points. The reality is this updated before the 10-year really started going crazy. So more than likely, depending on what happens with the 10-year tomorrow, this is going to go up. So this is not priced in fully, the increase in the 10-year again, because that went up. Let me show you guys towards the end of the day. You guys see that? So kind of went up during the end of the day, not reflected in residential mortgages yet, but sitting at 6.85 and here 6.23%. When we did it live on Sunday, this was under 6%. What a massive turnaround, man. I mean, that's absolutely shocking to me. Now, I'm going to give you guys a breakdown of what happened today in the market according to Market Watch, and then we're going to listen to a couple of videos, and then I'm going to show you guys a really amazing article from Zero Hedge. But again, this is the play-by-play from Market Watch. So stock market news, April 8, 2025, Dow erases, because remember, they just lost all of this. Think of the amount of money that it took to do that. Erases 1,460 point gain to end lower. That is how high the Dow was up today, you guys. Absolutely incredible. NASDAQ suffered major reversal amid tariff jitter. So this is all going to be about tariffs and Trump, and all the headlines are going to say that. But the reality may be a little bit different. Now, Dow ends down 320 points, and S&P falls for a 4th day amid renewed tariff jitter. So you can see, look at all about tariffs. Troubling pattern in Treasury, see, reemerges after White House confirms huge tariffs on China. Every single headline has the word tariff in it for the most part. VIX jumps above 50 on Tuesday afternoon as U.S. stocks drop. Very interesting. Let's keep going. U.S. oil prices settle below $60 a barrel on, you guessed it, U.S. tariff plans plus OPEC. Let's keep going. S&P sees no less than 21 lead changes in afternoon trading. A lot of volatility. U.S. stocks extend declines in final hour of trading as Dow wipes out a 1,400-point lead. Okay, violent moves in the U.S. bonds suggest big de-risking, but it's orderly? Seems orderly, doesn't it, Mitch? Seems very orderly. Trump tariffs are the biggest debacle ever seen in the markets, says analyst Dan Ives. Okay, that's very interesting. Why the stock market's wild swings are not going away anytime soon. And I want you guys to think about that. Let me show you guys this next article real quick. Here's the unsettling reason the world's most important market is getting hammered by, you guys guessed it again, Trump's tariffs. And I'm not going to get political. Please, you guys don't think I'm getting political. And I'm asking you guys, please don't get political. But this is what the articles say. So what Mitch and I are going to do is actually look at the math and try to figure out what is really happening. But before I do that, I want you guys to listen to a couple of videos. The first one is from Benny Sanders on tariffs. And I want you guys to understand that tariffs are nothing new. And people, including Bernie Sanders and right here, Nancy Pelosi, have been suggesting that we need tariffs for quite some time. So I want you guys to remember that, because I don't want them to manipulate you. We're going to listen to this first one. And if you guys can, let me know that the audio is okay. And I see you muted yourself, Mitch. All right, we're going to listen to this first one.
Further, what they have said is that we need to not worry about manufacturing in America, because what we should establish is a policy of unfettered free trade. We don't need tariffs. What we need is to allow corporate America the freedom to throw American workers out on the street, people who are making 15, 20, 25 bucks an hour, healthcare, pensions, throw them out on the street, because somehow, Madam President, we are going to create wealth in America and good paying jobs in America as we shut down plants. We move to China, corporations there pay workers 20, 30 cents an hour, and we bring the product back into this country. And anyone who goes shopping in a mall knows how difficult it is today to find the product made in America. But that is the philosophy. And I have to say, in that regard, the champion, and he is honest on this one. Senator McCain has been criticized recently for not being the most honest candidate we have seen in terms of his ads and so forth. He has been honest on this one. He is the lead advocate of unfettered free trade. And that's an also important part of this right-wing ideology.
All right, so he gets political a little bit, but my point is he's warning about what's happening right now in 2008. So if he's been talking about this since 2008, he's done nothing to handle it, and he's throwing our current president, I don't want to use names, our current president under the bus. Well, maybe he forgot what he said. Now listen to Nancy Pelosi back in 1996.
In terms of tariffs, I think it's interesting to note that the average U.S. MFN tariff on Chinese goods coming into the United States is 2%, whereas the average Chinese MFN tariff on U.S. goods going into China is 35%. Is that reciprocal? On exports, China only allows certain industries into China, of U.S. Industries into China, and therefore only 2% of U.S. exports are allowed into China. On the other hand, the U.S. allows China to flood our markets with a third of their exports, and that'll probably go over 40%. And it's limitless because we have not placed any restriction. In terms of jobs, this is the biggest and cruelest hoax of all. Not only do we not have market access, not only do they have prohibitive tariffs, not only are our exports not let in very specifically, but China benefits with at least 10 million jobs from U.S.-China trade.
So again, you guys, it's just to show you that politics divide us. And to me, it's the lesser two evils. An election may be an illusion of choice. Anyways, Mitch, you're still muted. I don't know if you do that on purpose. But I mean, that's why this live exists right now. It's so that you guys have more clarity, because we can't listen or trust the media or the politicians because they're completely useless. Completely useless. In fact, what they're doing is criminal right now. They're robbing us and manipulating us. Now, real quick, I'm going to cover this Zero Hedge article, and then we're going to go to Mitch and his thesis. We're going to take some Q&A from you guys. Let me throw this up on the screen because this is really good, you guys. Or normally I wouldn't pull this up, but this is a breakdown of what happened in the market today from Zero Hedge. It seems like Zero Hedge gets things right a lot more often than other news agencies. So this came out April 8th. This came out, I don't know, about 4-ish hours ago. Stocks erase early gains as White House pulls trigger on 104% China tariffs. The new tariffs will be collected beginning tomorrow, you guys, April 9th. Markets were predictably displeased. Now, you guys see here, again, here's the market when the White House says 104% additional tariffs, kind of goes down. Now, take a look at this, you guys. April 8th, 50% tariffs. The reason why this chart is interesting to me, because you see the divergence. So this whole time, China has been outdoing us on our tariff rates. But right now, because of the negotiations, you can see this skyrocketing up. I mean, Trump, call him whatever you want. I mean, his negotiations are freaking brutal, dude. Look at how much higher our tariffs are versus China now. I mean, the man is not playing no games here. He is bullying them. Clearly, only another Ackman meltdown or a Walter Bloomberg tweet can save us now. And this shows you how crazy the stock market is and how ungrounded it is for fundamentals. The stock market right now is a bunch of emotions and gossip. They have no fundamentals left. And look, you see that here. When anytime this guy talks, the market goes up. Look at this. It's just crazy. So stop listening to these morons. I mean, that's proof positive right there. U.S. equity markets are fading rapidly from a huge start this morning. And here it is right here, you guys. The offshore yuan falls to the weakest on record as trade war escalates. And you see that right here. This is the new low right here against the dollar. So against the dollar, the currency is dropping. Again, maybe they're doing that to pay off their debt. We'll get to that here in a minute. Further raising the specter of China trade war escalation with the possibility of a devaluation looming. And there it is right there. They may be doing that on purpose. Now, Zero Hedge their profile picture is so weird. Why they got some dude's torso there? That's making me jealous. You know what I mean? I'm dad, man. But look at this. I mean, what's up with this? It makes me feel uncomfortable every time. I'm like, anyways. So anyway, China has 3 options. Number 1, concede defeat to whatever terms Trump demands. Number 2, probably devalue the yuan by 20 to 40%. That's probably. Number 3, unleash the biggest fiscal stimulus in its history, which will push its debt off the chart. So not really good for China. Now, finally, bear in mind that as Goldman noted, those paying attention during the first trade war in 2018, no, they went back and forth, but they essentially made peace. And this stuff here is basically going into the fact how Trump's comments made the market explode. I think, what was it, today? Yeah. So it's so frustrating because none of this is fundamentals. This is just words from people. But listen to this. If the U.S. escalates its tariff measures, this is from China, China will resortly take countermeasures to safeguard its own rights and interests. But these are reciprocal tariffs. So what about the first punch you guys got? You guys got the punch. My eye's black right now. What about my black eye? Are we just going to ignore that? And listen to China. China will never accept this. If the U.S. insists on going its own way, China will fight it to the end. Very powerful right there. But look at this. When Trump said China wants to make a deal, boom, S&P futures shoot up. So again, there's no fundamentals there. That's just some words that some man who's our president said. That's it. And this last thing, you guys, Wolf Research says Monday's sharp intraday reversal driven by fake rumors. Why does that say Monday? Today's Tuesday, right? So I'm not sure why it says Monday. I don't know. It is what it is. Driven by fake rumors of a 90-day tariff pause highlights just how fragile markets are to tariff headlines right now. The firm believes the president could stop or lessen the sell-off with a single social media post. So it seems, Mitch, that social media posts are the new fundamentals. So I don't know. Gossip is the new fundamentals, apparently. I don't know. Seems that way. All right, so that's going to conclude that part of this. I think I got through that really quickly. Mitch, I'll share your thesis here in a second, but is there anything you want to say about the market update before we go into your thesis?
The move that occurred today in the NASDAQ was 1,300 points top to bottom. That is the largest move in the history of NASDAQ in one day. The bonds, sorry if I look left, but the bonds over the last 2 days are not signaling a lowering of the interest rates, just the opposite. They're signaling an increase in the interest rates. Everything in the press, well, we're going to lower, we're going to lower, we're going to lower. Go and read the chart, because the chart says, no, they're not going to lower, they're going to increase. Nobody knows what's going to happen, but look at the size of the bars on the bonds. So just a couple other points. First off, as we go through what we're about to discuss, I want to make a handful of issues clear. One, the press is wrong, and people should simply stop watching the press. They couldn't be more wrong as to what's going on. Isn't it interesting that in 2008, 2009, the leadership, both parties, were stating, well, we have to have tariffs. The leadership of both parties have caused exactly where we are today because they didn't pull the trigger, and the rule of 72 has now compounded what was then the debt plus the debt that has been created by the Federal Reserve. So it is the leadership that created the growth, the economic growth of China by subbing out our culture. So understand, they screwed up. Now, all these machinations that are on the go, and we're going to get into that with regard to the Federal Reserve and the reverse repo. That's a machination to try and cover up the fact that they've screwed up. But the cover up blows the bubble. It makes the bubble that much larger. So the other point is, this is not about tariffs. That is an illusion. This is about currency, and this is about debt, exaggerated debt in all countries as a direct result of any country that's got its own IMF, its own central bank. They're manipulating their population, they're manipulating their currencies, they're manipulating their income, and that is what this is about, and that is what the leadership screwed up on when they didn't remove the tariffs to begin with. They should have put them in place, they never did it. They should have never allowed the growth at the expense of the United States to occur. So this is really about nationalism and trying to put the genie back in the bottle. The problem is what we're about to go through is how the genie was created in terms of the debt that was blown up to the point where the bubble is so large. What you are now witnessing live is the pop of the bubble. And open trade is a necessity, because if you keep blowing this bubble up, there will be one day where it just simply disappears. The pop is so large, there is no credit left in the system. If there's no credit left in the system, you won't be able to borrow 2 cents. It will simply implode. And we came real close in 2008 to that occurring. Maybe it should have occurred. But regardless of that, we're going to get into all this in a minute.
Mitch, I want to put up David's comment here and his question. He just gave us a super chat of $50. David, I really appreciate that support. This is my full-time job now. Everything helps, and I can't do this without you. So thank you, brother. And then I wanted to get to something a realtor was saying right here. You know, I can't. I'm gonna be nice. So here's David's comment right here. Tucker with Besant in what is that?
Interview. Besant interview.
Oh, okay. Okay, interview. Okay. Besant says, make America more like Florida to reduce spending. As the bond salesman he is, he hints at huge tax increases. War may slow his sales. Could he be selling with the stipulation of huge taxes on us? What are your thoughts on that, Mitch?
I don't know what they know. I will tell you that that's a recipe for a disaster. You cannot get blood out of a stone. And the disaster would be a civil disaster. In that if you make people desperate because they can't afford the roof over their head, best you learn how to duck. And that is a big problem. So on one hand, they could be talking their book as to what they're trying to do. On the other hand, if you want a civil war, go ahead, raise taxes, because that's where you are. You cannot get blood out of a stone. Mom and pop don't have it. We've already proven that 37% of the households are going to go bankrupt and or lose the roof over their head due to the inflation. The DTI, the debt to income, which is ideally stated at 28% per Fannie Mae and Freddie Mac, the truth is that number's got to be closer to 21 or 22% due to the inflation. So the bottom line is mom and pop are out of money. And that's what you're starting to see. And that's why President Trump is saying we've got to get money into this country. And one way to do it is through these tariffs. But as I've said, the tariffs aren't what the issue is. It's the debt that is the issue and the currency that is the issue. The tariffs just happen to be a ramification of the issues.
Very good, Mitch. And I got there's so many good questions. I know we're going to get in a situation again where there's so many good questions. I'm freaking out. I'm trying to get to the questions. You guys have so many good comments and questions here, and big respect to you guys. Oh my gosh. So we got a lot of support as well. I just wanted to, let me just give a shout out real quick, and then we're going to get into all of your stuff, Mitch, here. I can't keep up here. Evan, thank you for the super sticker. I really appreciate that from the bottom of my heart. P Nice, I know you did as well. You got 7 memberships for people. I really appreciate that. P Nice, here you are, buddy. P Nice, I lost you because the comments keep coming up here and I lost you. Oh, here you are. P Nice, brother. I appreciate that. I cannot do this without you guys. David as well. I see the $5. Okay, so David, he has one more comment here. I think it's critical to think of speed. Okay, so, okay, good. Markets suck today. WS wants QE, obviously. If we are first to QE, we will see blood in the streets. What do you think of that?
It's possible. I mean, because the quantitative easing isn't going to work, and neither is the quantitative tightening. The only thing that works are fair markets, and we don't have it. And that's why you're seeing these reactions. As bad as these reactions are, they are occurring. And that bond market yesterday and today, that's not good.
And Mitch, I have a whole bunch of housing market questions here. You guys, I want to get to your housing market questions. As long as we have enough time, I have a segment at the end of this that will go into the housing market. I love talking about the housing market. And Nikki, I'm pulling your comment up because I lost your email, Nikki. I wanted you to be a moderator. It's not that I didn't respond to you. I don't have your email. Nikki, please email me again. I lost your email. I'm so sorry. I do want you as a moderator. I just lost your email, so I wasn't ducking you. Mitch, you ready to work on your thesis now? Do you want to present your thesis to everyone? Oh my God. Hold on. Deuster, member for 29 months right here. Look at this. You absolute beast, my man is Deuster. I'm sorry, Mitch. I'm sorry.
No
Go
problem.
ahead, buddy. Do you want me to? You ready?
Yeah, I think so. I think we can try to make this work and see how this goes.
Okay. Let's add it to the stage. Okay, guys. So, oh wait, that's mine. Here's yours. Okay, so what you guys are looking at is Mitch's thesis on exactly what's going on. He's going to try to keep this short and sweet. Let me put it like that, and I'm going to put our timestamp here. And we may put a presentation or a seminar together on this. It just depends what you guys want. But Mitch, I got us timestamped. Whenever you're ready, go ahead and go over this with viewers.
Okay, so what we're going to do, I highlighted everything in yellow. This document's actually 45 some odd pages. But what I've highlighted in yellow is the most important parts to try and get through this with a little bit of speed. So what I did is I created what's called the thesis and facts. And this is all about derivatives. And we'll go through this, but the derivatives are actually being used by our Federal Reserve. So the Federal Reserve and the central appraisal districts are the largest purveyors of fraudulent bond debt on the globe. With regard to the central appraisal districts, which are owned by the taxing entities, those are the school districts, you can see the First Amendment to the criminal complaint, which has been filed with the DOJ. By the way, somebody asked, have I heard back from Pam Bondi yet? The answer is no. With regard to
You
the
saw that?
Yeah, I saw that.
I'm sorry. How did you see that?
I can read.
Oh, I didn't know I put it up there. Okay, I'm sorry about that.
Yeah.
Okay.
So with regard to the Federal Reserve and the reverse repo market and the associated interagency credit and security agreements, the following will attempt to connect the dots by answering a few questions. So I put myself in the position of mom and pop and just said, what questions would people like to have answers to? 1, for what purpose does the repo and the reverse repo exist? Who receives benefit of the reverse repo? Who are the participating banks? Is the reverse repo a tool of illusion? Should the Federal Reserve be closed? If the cost of carry, that's the interest, of any bailout in history, that's the principal, is greater than the economic benefit, if any, from the bailout, how exactly is bailing out the banks an advantage to society being mom and pop? Now, obviously, based on what we discussed here already today, the answer is it's not. But this is about to get a lot worse, and you're about to understand what's going on. Has any politician in the history of the United States ever studied the rule of 72? That's where debt doubles every 5 to 7 years, just depending on the interest rates. The derivatives market is gigantic, estimated at over 1 quadrillion. That's 1,000 trillion, and that's on the high end. How can that be? Largely because there are numerous derivatives in existence available on virtually every possible type of investment asset, including equities, commodities, bonds, and currency. Some market analysts even place the size of the market at more than 10 times that of the total world's gross domestic product. The gross domestic product of the United States, just as an example, is 51.5 trillion. Okay? So a quadrillion is 20 times bigger than the US GDP. The US stock market at 51 trillion, and that's as of April 8th, today. The derivatives that you can't see over and above the stock market are roughly 20 times larger than the stock market. Although I don't have access to AI capable of determining what all these derivatives are and who created them and for what purpose, what can be determined is how much of those derivatives are just paper chasing paper, meaning not backed by any actual asset. And give or take, the answer is roughly 825 trillion. What you can't see are the unfunded credit derivatives, the funded credit derivatives, credit default swaps, credit default swap options, credit spread options, total rate of return swaps, credit linked notes, constant proportion debt obligations, collateralized debt obligation, off-balance sheet derivatives, i.e. deferred bonds, credit default swaptions, synthetic credit linked notes. You can't see any of that. You can't get the totals. And that's one of the reasons why the press is so badly wrong. They talk about something they know nothing about that they can't quantify. With regard to the deferred bonds, I want to make a point on that. Turns out there's a school district in Johnson County that's trying to defer its bonds. Well, the entire board of that school district should be put in handcuffs effective immediately for accounting fraud, bank fraud, wire fraud, and mail fraud, as well as a school superintendent. So think this through for a second. If you've got bonds that are due, but you want to defer the payment of those bonds, that means that the interest gets added on to the back end of those bonds. Well, the school doesn't have the money to pay the bonds current today. How are they going to have the money to pay the compound cumulative effect of the bonds tomorrow? The answer is they aren't. They're bankrupt, and they must take bankruptcy. And anything over and above stating that, that means that that school superintendent and its board signed off on financials where the books are cooked and they knew it. So I have a question for those particular people, the school superintendent, as well as the board. For the last 5 years that you signed off on those financials, did you make a disclosure to the public that the school district is bankrupt and you couldn't afford to pay the bonds? Yes or no? Well, if it turns out the answer is clearly no, that means for the last 5 years, you, the school superintendent, and the board have committed bond fraud and accounting fraud. So you see, these things are all compound cumulative effect. And when they're discovered, it's very easy to point to accounting fraud. Going back and look at these credit linked notes that you can't discover because you, the public, can't see them. Collateralized debt obligations, the CDOs, you can't see them. That's the point of this section here. Lenders or investors possess varying degrees of risk tolerance. Debt securities come with several types of risk: interest rate, liquidity, credit, prepayment, etc. To hedge them, investors enter into derivative contracts. Derivatives are financial instruments that confer the same value as their underlying financial asset to the holder without the right of ownership over them. Basically, paper chasing paper. So this goes on to describe what that is in terms of the CNLs, et cetera, or CLNs, et cetera, and the credit default swaps. But here's the underlying point of this one section. Our Federal Reserve, through the repo and the reverse repo, utilizes these instruments and collects these instruments and says that these instruments are at face value. Well, given the last 2 days of downdraft, 4 days, depending how you look at it in the market, how could a face value be face value? It isn't. And very shortly, we're going to get into a chart, and it's nothing more than a giant circular chart showing how the Federal Reserve is, in fact, through the reverse repo, committing fraud on the public. One of the reasons why it should be shut down. So the next section here talks about U.S. Fair Value Guide. And I'm not going to bore everybody. That's why it's not highlighted in yellow. Here's the point. All those numbers, ASC 820, 815, et cetera, those are all methods of accounting to take into account how those instruments are supposed to be valued. Here's what's interesting. The accounting methods, as outlined above, are not being done because the players are very sophisticated in their methods, which the oversight committees can't follow. Just like that found in USPAP, Uniform Standards of Professional Appraisal Practice, which is not being adhered to. It's the exact same thing. They're a mirror of each other. We create the laws, we create the rules, we can't follow them because we don't know what they are. Rules are useless if they're not followed and understood. So what are the risks by the Federal Reserve accepting these instruments at face market value? 1, fraud on a mass scale. 2, counterparty risk. That is, that the party goes bankrupt in the process. Well, if you look at those bonds that have happened today and yesterday, the devaluation of those bonds, that is what could be a third party and or a counterparty risk. That money is huge. That's a sovereign wealth fund doing that. A group of retail traders aren't big enough to move the market. Next item at risk is the credit risk itself, because it turns out that the instruments that they've accepted, the face value isn't the face value. Market risk, well, that's exactly what's happened in the last 4 days. Liquidity risk, those bonds dropping and the interest rates rising, that has the potential to create what we've already been through in 2008, which is a complete lockup of the credit market. Here we are. The legal risk, well, this one's pretty interesting because it's not just US-based legal risk, but it's the country's risk across the globe. It's multiple countries that are participating because they are stupid enough to literally pick up the exact same nonsense that our Federal Reserve has created. And our Federal Reserve did this for the sole purpose of backstopping the banks. They are not there. They never have been there to protect mom and pop. So countries like China, Europe, Britain, they all did the same thing with their own central banks. And that is the fraud on society. So the question became, could the above be a fabrication from which dollars are churned and fees generated? There's an interesting chart coming up. What I did in this document, and Travis will post this below, but everything that I've got in red is a pretty interesting question. And when we started this video today, I said we were going to drive a freight train over everything that you've heard in the press. Here it is. I have one question. What happens when the alleged assets backing the paper are devalued or the counterparties levered their position in other derivative contracts such that the counterparty is no longer a viable entity? The assets that the Federal Reserve has accepted at face value aren't at face value. The Federal Reserve may not even know who those entities are that are teetering on the brink of bankruptcy today, even though they're supposed to be tracking the tier one capital. What you're about to see as to who the players are is going to be very enlightening. Long-term capital management was a highly levered trading firm whose strategies failed to pan out, with losses mounting due to Russia's debt default. This occurred in 1998. Ultimately, the Federal Reserve had to step in and bail them out. What's so interesting about the long-term capital management is that they had $5 billion in assets. They controlled over 100 billion worth of notes. Well, that's a 20-to-1 leverage. Isn't that interesting? We've said 20-to-1 leverage on the school district bonds. These things are a mirror image. Had the derivative positions whose total was worth over 1 trillion, they took that 100 billion and they levered it into 1 trillion. So it was 20-to-1 on the initial leverage, then it became 200-to-1. And that's why long-term capital management blew up. Now, everything we're about to see in today's world is bigger and worse. Long-term capital management's highly levered nature, coupled with the financial crisis in Russia, led to the hedge fund to sustain massive losses. The point of all this is, at that point in time, the loan fund was 3.6 billion to bail them out. Right now, today, remember, the compound cumulative effect of all that money that was borrowed to bail them out is still ticking. That's the problem with all of this. If you don't get rid of the debt, the compound cumulative effect eventually will bankrupt you. And that's where we are. So today, roughly 800 trillion of derivatives, not including the US national debt and unfunded liabilities, is exactly what we are talking about, and the ramifications of why the tariffs are necessary that should have been put in place 20 years ago, but they weren't. Compound cumulative effect. All hard assets in the United States built since the creation of the United States is roughly 153 trillion. That means that the derivatives market is roughly 9 times greater than all assets in the United States. All assets meaning land, buildings, everything, lock, stocks, the whole 9 yards. Or 90% of the derivatives market is simply paper chasing paper, creating the necessity to build debt to rescue the banks, and as a result, creating inflation, which is a hidden tax on all taxpayers. There's a large difference in the notional value and the actual netted value of the derivatives. 600 trillion versus 12.4 trillion as of 2021. The point of all this is that 600 trillion worth of paper isn't backed by any assets other than the paper itself. Can you imagine that we would be in a completely different world if that paper chasing paper didn't exist? And who's getting rich of all the fees on the fees because that paper chasing paper does exist? I have another question. What happens when the alleged assets backing the paper are devalued when those assets may be cross-collateralized shares and or US treasuries? or the counterparties levered their position in other derivative contracts such that the counterparty is no longer a viable entity. Yes, this question is slightly different to the prior question because what has happened, I'm going to go through the banks and show you who's behind all this, but those banks have interbank relationships where they actually backstop the debt of other banks. China has done the same thing. They take our US treasuries and then they say, well, this is cash, same as money. Cash is money. We have the US treasuries. We'll lever that into our yuan positions, our Chinese yuan positions, and we'll go and build ghost cities. Well, okay, what are those ghost cities worth? There's no income. They're a ghost city. There's nothing there. Okay. Therefore, they used our treasuries to backstop whatever it is that they wanted done. None of this is real because none of it had any value to begin with. It's all kabuki theater. So what we have today is 1 quadrillion worth of derivatives, which is 200,000 times larger than the $5 billion capitalization of long-term capital management. See the problem? So then I put this other portion of the article together, how reverse repos work until they don't. And I'm not going to go through all of that because I want to get down to what's really going on and who the participants are. The reverse repo allows people, banks, whoever it is, who put their money into the treasury to earn an additional fee. It's like goosing the rate of return that they would normally get had they just bought the treasuries clear. So the reverse repo is the equivalent of picking up pennies in front of a steamroller. The leverage, someone else's money and or collateral, is high and the return is minimal, meaning the reward is minimal given the true exposure of the mispriced collateral. Remember, I said that the Fed takes these notes, these underlying assets, at face value. There is no face value to them. It's a guess at best. And when the market starts doing what it's doing now, it's worse than a guess. It's a guess. It's probably criminal. So let's look at a very simple chart. And there's multiples of these charts, and I'm not going to go through all of them. I just want to make the point that the money is moving in a circle. That's all that's happening here. So you have cash investors, hedge fund investors, asset managers, and others, and they go to a securities dealer, i.e. JP Morgan. JP Morgan has a prime services or a hedge fund. They mix the money, they turn it into a security, and that security ends up going back in some form or another to be used as collateral with the Federal Reserve, and that's called the reverse repo. And then there's a tri-party repo, there's a repo, a tri-party repo, and a reverse repo. So what this chart is showing, which is pretty interesting, this is the repo dealer intermediation. Again, the only thing that's important is that you understand this is a giant circle of paper chasing paper. There's nothing here to support any of this. So the counterparty A has cash, they go to the dealer, the cash in, the dealer goes to counterparty B. Counterparty B turns right around, puts it back to the left-hand side, collateral X, and then hands it over as an asset over to the treasury. It says, okay, fine, we're going to give you our treasuries in exchange for your asset, and you're going to be allowed to earn 0.01% overnight while that's sitting there. That's the whole theory behind this. It's basically a giant circle of fraud. So to get to the point, I have one question. What happens when the alleged assets backing the paper are devalued, mispriced, or wrong mark to market? And based on what we had here tonight, horribly wrong mark to market, or found to have more than one party of ownership, because we've discovered that gold can actually have more than one party of ownership at any one time. Or the counterparties levered their position in other derivative contracts in exchange for the reverse repo, such that the counterparty is no longer a viable entity. The answer to that question is, boom, it's over. So then we have the transmission of the monetary policy, and you can read this on your own if you've got an interest in it. The monetary policy is transmitted through market interest rates to affect consumers and producers' spending decisions. I will state that what you're reading here is not true, but I thought it was important to put it in to prove a point. which ultimately moves the economy towards the Fed's objectives. And that's why it's not true. We'll get to that in a second. The monetary policy implementation framework ensures that when the FOMC changes its policy stance, that is, it raises or lowers the target range for the federal funds rate, market interest rates and financial conditions move in the desired direction. Again, this isn't true. All you have to do is go and look at the bonds. Are you telling me that's a desired direction? It simply isn't true. What the bonds are saying is, holy crap, we're going to have to raise interest rates, not lower them. Therefore, monetary policy is partially derived from market conditions of the participants in the reverse repo market, which is crafted by the Federal Reserve. Really? Baloney. Because if that was true, we wouldn't be having this discussion here today. The Fed tells the press, we want maximum employment. Clearly, they failed. The Fed states, we want inflation at sub 2%. Clearly, they failed. For what purpose does the Fed exist but for backstopping the weaker banks? And everything I've highlighted in yellow above proves the point that the Federal Reserve should be shut down, but it gets worse. By the way, these charts are really good. If you've got the time to study them, to see how the flow of money really works, it's fascinating. But let's just go down. This is a solution, and I'm not going to go through all that, but the gold standard ends up being a major chunk of the solution. That's where we're headed. What I want to show you is who the participants are. This is the reverse repo counterparties. Take a good look at that list of banks. There's the government-sponsored enterprises, as in government banks, government divisions. Federal Home Loan Bank, Pittsburgh, New York, Indianapolis, Boston, Atlanta. Here's the investment managers, the people that get money, fees in between for making the arrangements between the counterparty and the Fed. Take a good look. Look at what's highlighted in yellow. BlackRock Fund Advisors, Bank New York Mellon Investment Advisor, Capital Research. These are major banks, companies. Charles Schwab Investment Management, Columbia, DWS. DWS is out of Germany, Deutsche Bank. Federated Investment Management, Fidelity Management. Look at all of them. These are all people that are picking up fees in between for creating paper, chasing paper, not backed by any asset other than the paper itself. I have just one question. Where are the cross-collateralized loans between the banks and the government sponsored entities disclosed? Those are the banks. Where are the disclosure documents? Who got the money and how much did they get and when did they get it? Or are these all off-balance sheet financing methods? Again, if they're off-balance sheet financing, that means the public can't see them. Speaking of off-balance sheet methods, accounting fraud, this is what I was referring to above, which is what the school districts are now wanting to do, is to move their bond debt off balance sheet by deferring their bonds. And they can't do that. I mean, there's no accounting law that allows them to do that. The point is they're bankrupt. They need to take bankruptcy and get this over with. Isn't it interesting that the Fed hides the liabilities off balance sheet, as does the school districts, which own the central appraisal districts? Again, they are a mirror image of criminality. Now, here's the dollars. Federal funds sold, reverse repurchase agreements. Look at the banks, look at the dollars. This is the amount of money that's going back and forth in the tri-party agreements between the Federal Reserve and these banks. And every time that money moves, somebody's getting a fee. And if you think there's real estate below any of that, there isn't. It's paper chasing paper. Here's more banks. This is a little bit less money. So the repurchase agreements, I thought that this article was important to put in here because it walks people through a more simplistic way of understanding what's going on. So I put it in on purpose because the charts are pretty good. Graphs are pretty good.
Appreciate you, Mitch. You're doing well. I told you it wasn't going to take you 7 minutes.
I was trying to get through quicker.
No, you're doing good. Take your time. You're doing perfect. Take as long as you need.
Okay. Over and above the problems that we've already stated, just to show you how ridiculous, stupid, criminal, and foolish they have created a system to defraud the public. Read what's in this section here. Another trend is the growing importance of sustainability in the repo market. The repo market, understand, is the Federal Reserve, with financial institutions and investors seeking to incorporate environmental, social, and governance considerations into their repo transactions. I don't care who it is, but any bank that did this is the first target to be put out of business. The board is wrong. The executive branch of the bank is wrong. They are all wrong. The theory behind it is supposed to be pristine. We're going to help the bank because that's what the Fed is there to do, even though I completely disagree with them. The Fed should be shut down. But when they start mixing and matching things that cost more money, who ends up paying for that? Well, that's us, mom and pop. We end up paying for the fraud that they're creating. The rise of fintech companies is also expected to play a significant role in shaping the future of the repo market, with these companies offering innovative solutions for repo transactions. There isn't a stitch of truth on this planet to back up that statement. It wasn't real. It never happened. It can't happen. And the person that wrote this article, and that's the reason I put it in here, is to help everybody understand, do not listen. If you don't have the data to back it up, they are talking and they do not know what it is they are talking about, i.e. the press. That's where this came from. But I put it in here on purpose to make people understand how stupid and criminal this type of situation is. There are many problems in the above article, including ESG, which is another fraud on society. I put the above article in the thesis and highlighted the above paragraph to show the interconnectivity of politics, which has nothing to do with true economics, but which has everything to do with committing fraud on a mass scale. However, the concept of what the repo and reverse repo are supposed to do is the exact opposite of what is happening. In reality, as the end result is the compound cumulative effect of blowing the bubble even larger, and to that point, 600 trillion of derivatives larger. That's not what's on the exchange. That's just pure paper chasing paper. It's what you can't see. The exchanges, the CME, whatever exchange you have, they're clear. You can see that money moving. It's what you can't see below the hood. It's the paper chasing paper to the tune of 600 trillion at the hands of the Federal Reserve. I think that's all I had on this particular one.
That's all you had on that particular one? Sure.
Yeah, because we talked about the market before. So yeah.
Okay. Okay. I'm going to take it off the screen then. Okay.
Okay.
I have a couple questions for you, but for the viewers real quick, let me know if you guys want me to go, because I have some stuff set up here. We'll go into what Mitch just went over here. But if you guys want me to talk about the housing market in all of the cities where the inventory is higher than pre-pandemic, this is what I need you to do for the viewers. I need you to type bonkers in the chat. So if there's enough bonkers in the chat, we're going to go over the housing market. But Mitch, I want to start. Can you tell us what the futures are at, first of all? Because take a look at this real quick. Let me take your screen off.
NASDAQ is right where it closed. Okay. So it's quiet right now because it's after hours.
Okay. It looks like the Chinese yuan offshore to the dollar is still going down. Shot up, still going down. Can I ask you this, Mitch? And there's some great questions here we'll get to. Do we have any bonkers? Yeah, we got some bonkers. Mitch, can you talk to the viewers about how this could possibly be China just manipulating markets to devalue their currency to pay off their debts?
Yes, because if you think about it, that is what our government has attempted to do, right? That's what happens with inflation. So they will inflate values, but your purchasing power goes down. So in essence, you're paying off debt with inflated values that aren't real because your purchasing power goes down. Well, again, China has mimicked our growth. They took what criminality has occurred at the Federal Reserve and built it into their own central bank. And it's not just China, it's not just the United States. Like if you look at the currency of the British pound right now, it's $1.29. So, or between $1.27 and $1.29. So the point is, Britain is in much worse economic condition, probably than they've ever been. And they rely on the United States, and they have relied on the United States to come in and backstop them in the past. Well, I don't know that that's going to happen right now, but if you think that their currency is worth $1.29 to $1 US, you're crazy. Flip side of the coin is that the Australian dollar is at 60 cents to the US dollar. So it's really, like I said, this has got nothing to do with tariffs. This has to do with debt and currency. That's the point that the press is completely missing. They don't get it. They don't understand it. They're not nearly as smart as what you now know based on the document I just went through. That's the truth. That's evidence. Press is completely clueless. So to Travis's question, this is currency manipulation. Why? Because they want to pay off their debts, which they can't do because mom and pop there can't afford it either, but they want to pay off their debts with lesser valued currencies. It's a race to the bottom. That's the reality.
I just love being manipulated, Mitch. It's just so fun being manipulated and not being able to get the truth from anyone. Don't believe your lying eyes. Don't believe them. I want to go into the housing market, but I want to put this on the screen because this person has said this a couple times. And remember, I talked to you about this actually today. Thanks for all the work, guys, for all the mess. You should look deep in the yen carry trade, which value is in the 20 to 30 trillion. So I was talking to you about that today because I was trying to figure out what was going on with the 10-year. And I was like, do you think this has anything to do with Japan? But do you have any comments on this before I go into the housing market?
Part of the problem, that's what makes a market, right? So you have different opinions, and one entity will take one opinion and trade against it. The other entity will take another opinion. Part of the issue is in the Forex world, you can only deal, if you're smart, you can only deal with the chart that is in front of you. You shouldn't be listening to the noise because there's too much noise that'll get in your head and it'll screw things up. Part of the problem is you don't know who the players are that are moving the big money. And they have what's called the commitment of traders. And all that does is say, well, X amount of dollars has gone through the hands of the exchanges on any given day. But it doesn't tell you who they are. But when you look at the size of the bars, you know that that must be a sovereign wealth fund or that must be a country. And on an average day, there's trillions of dollars that change hands in the stock market on an average day. So the average bars are just average bars, and NASDAQ might be 200 points. Well, when you've got a top to bottom swing in the NASDAQ today of 1,300 points, these are sovereign wealth funds that are pushing the buttons. Retail traders can't do it. So that's part of the problem. And that's why I keep saying you have to look at the numbers on the chart and forget all the white noise as the reasons why things are happening. It's just not relevant.
All right, we're going to go into the housing market. But I want to talk to the homeowners first, okay? So I made a post on my YouTube channel. Let me put this up here. Good job, by the way, Mitch. I'm going to put this up, okay, because I want to talk to the people right now that already own houses, and then we're going to go in to look at some data. If you already own a house, it is so vital that you guys protest the value, protest the notice that you get from the Central Appraisal District. Now, I made a post right here. If you own a house, you got to do this. Okay. Now I have a seminar this Saturday. If you guys want to come to the seminar, we still have seats. We have 32 people max. It's going to be a good seminar. I'm going to teach you guys how to fight the value. But if you can't come to that seminar and you got a notice like this, some of them look different, but if you got a notice like this and you can't come to the seminar and you haven't watched the courses that I made for you, the first 3 steps, okay, number 1 is you got to create an online account at your CAD. That's the Central Basal District. So you go there, whatever, hcad.org or whatever it is, and you log in and you make an account. Usually they need a warranty deed or a driver's license or something like that. The second thing you do once you have an account already registered is you start the protest process. It's going to ask you some questions. It takes about 10 minutes. Normally it's going to ask, why do you think, why are you protesting? Typically, you're going to want to answer incorrect appraisal value. The third thing is request either their comps, their evidence, or their grid from the CAD. They have to provide you information and evidence on how they come up with your value. We need that grid because we're going to take that grid and we're going to figure out how they come up with your value, and we're going to use that against them. So those are the first 3 things. Again, if you guys can come to the seminar, please do it. The link is here. This is under my posts on my Real Estate Mindset channel. So I hope to see you there. If you're not, that's okay. Do these 3 things and protest. Okay. Now, as far as the housing market, did I put the timestamp? Oh my God, I didn't put the timestamp. Oh, okay. Hold on. Let me put the timestamp. All right. So as far as the housing market, this is from Lance right here with Fast Company. Okay. This is crazy. Okay. What you guys are looking at here are metro areas with more inventory than pre-pandemic. Why is that important? Because we've been hearing and being bullied and lied to this whole time about how house prices will never go down because inventory is too low. But I don't hear those same people talking anymore like that when these metro areas have ballooning, skyrocketing inventory. What's the next ingredient? Probably prices going down. But regardless, take a listen to some of these places, guys. First is Killeen, Temple, Texas. That's right here. Okay, that's in my state. That's up 93% higher than the inventory that they had March of 2019. So they have 93%. Think about what I'm saying. 93% more inventory pre-pandemic. Punta Gorda is at 89%. Lakeland, Winter Haven in Florida, 61%. Colorado Springs up 58%. Huntsville, Alabama, I've been there, is up 50%. Denver up. You guys, congratulations if you're in Denver, Colorado. That is up 43%. Waco, Texas is up also 43%. McAllen, a lot of Texas up 40%. Austin up 38%. And I think that honestly, guys, obviously the new home construction, you guys hear me talk about that. Clarksville, Tennessee up 38%. San Antonio, Texas is there, 38% higher than they were pre-pandemic. Boulder, Colorado also up 38%. Memphis up 36%. Cape Coral, and Fort Myers, Florida up 36%. Corpus Christi, Texas. So Texas and Florida all over this list. I'm saying again, new home construction. That's why they're all over this list. Crestview, Fort Walton Beach, Florida up 32%. Orlando up 31%. And this is higher than pre-pandemic, keep in mind. New Orleans, right down the street, up 30%. Was that Spokane, Washington up 29%. Lubbock, Texas, Port St. Lucie, Florida's up. Daytona's up, Pensacola's up, Beaumont and Port Arthur in Texas is up. I mean, this is absolutely astonishing. Palm Bay or Melbourne, Florida's up 21%. Northport is up 20%. Also, Dallas is up 17%. Tampa's up 16%. Jacksonville, San Francisco, Eugene, Gainesville, Tuscan, Arizona, Myrtle Beach, Fort Wayne, Santa Rosa, Phoenix also up 7%. Nashville's up. Prescott Valley in Arizona's up. Lake Havasu is up. I almost said something else. If you went there when you were a kid, you know what I almost said. Dauphin, Alabama's up. Naples, Marco Island in Florida is up. Salt Lake City, Utah's finally up. Houston, that's me, up 5%. Told you. Springfield up 1%. El Paso up 1%. Honolulu's up also 1%. And that's what's going on right there. Let me show you guys interest rates to what Mitch was saying. The market has completely, so the market's all over the place. This is CME Fed Watch. And first thing I want to point out is they've removed any possibility that the Fed's not going to cut rates. The market is so crazy right now. First of all, the next meeting is in May with the Federal Reserve. The market is saying 50-50 chance to cut rates. But look at this, and look at this. This is at 425 to 450. That's where we're at right now, 425 to 450 basis points. But come June, look at this. They've removed that category completely. So the market has left no room for no rate cut. They're always wrong. I wouldn't put money on this, but it is what it is. Thought that was pretty interesting. I'm going to take some questions now on the
I
house.
have a comment.
Yeah, go ahead.
So when you're getting your protest notices, typically there's 2 boxes to fill in. Fill in both boxes, one of which says you're protesting the value. The other is you're protesting the uniform and equal value. Typically there's 2 boxes. You want to make sure you check them both in.
Okay, very good, very good. All right, let me see. Let me find some of this first. Oh, CBD, BC. Thank you for the videos and information. It's our pleasure. Thank you for the support. What is that on his icon right there? Is that a cat? I don't know. It's a dog. It's a dog. Sorry. It's a dog right there. It's pretty cool. All right. Thank you for the support. Let me see. I had some housing market questions. If you guys got some housing market questions, throw them back up. I can't find them now. I've saved so many stuff. Okay, so here's one right here. So forget trying to buy a house this year in Houston, Texas. The thing is, Pirate, you could do whatever you want, right? What I'm going to do is I'm going to continue to look for a house like I've been continuing to look for a house for 2021. The key is this, okay? I'm not going to settle. And I'm going to use fundamentals to buy a house. I want to buy a house. I want to be bullish on the housing market, but I cannot be, being that we are in the most toxic housing market in our history from both a information standpoint from bad people and price and payments, price being the most important thing. So I don't know. Forget buying. I'm not going to forget buying. Now, I say that because if you can find a house that you love that has plenty of wedge, like say 30% under market value, and you can find that right now. I can find houses 30% under value in my market. But there's another thing, cash flow. If you can find cash flow, if it's under market, if it's cheaper than your rent, if you have plenty of money saved, if you have no credit card debt, it may be time. But the likelihood is low. You have a low likelihood for finding something that I just said. So there's very, very low likelihood. So the important thing is you've got to be an expert in your local housing market in Houston. Look at the comps, look at MLS, and it's not going to be hard for you to figure out what's a good deal and what's a bad deal. So as far as I don't think so. I don't think any of us should keep our heads in the sand. I think if we want to buy a house, we should at least look and understand. But if we're too emotional and we're just going to buy, then no, don't look, right? If it's going to hurt you and you're just going to go buy something, then don't look, because you don't want to bury yourself either. Mitch, you want to say anything there? You look like you did.
Part of the problem is helping people understand what it is that they're buying. And if you looked at a house and you said, okay, I'm going to create a pro forma on that house as if I'm going to own it, but I'm going to rent it. Well, that means you have to have an economic rate of return on your money. Well, if you put a pro forma together and you do it properly, that will back into the value of what you should be paying for that house in order to make an economic yield. If you can't make an economic yield on what you're buying, best not to be buying it, because very soon it will be cheaper.
Yeah. And to your point, let me see here. So here's someone saying the comps are very inflated, not a good tool to use. We could use our emotions. I mean, we got to pick the lesser two evils here. We could use our emotions. I don't think we should use our emotions. Just use the math. To their point, though, that's a good point. So if we're using comps, right, and we're using those comps to find the wedge or to do that pro forma, which is kind of like cash flow, and the whole market goes down 20%, then what good are the comps?
Well, I'm going to tell you that's why you value it based on a pro forma, based on income, because it takes all of that nonsense out of the equation. First thing. Second thing is, whose comps? From the Central Appraisal District? Those comps aren't worth anything.
But well, not only that though, even if the market goes down, say you find a house today that has 30% wedge, if the market goes down 20%, you still got 10%. So I mean, there's multiple reasons why to find a wedge, and also a pro forma of cash, like cash flow and things like that. Let's see here. And then if you guys got some more questions, put those questions up. How about this, Mitch? I don't know if you have any more info on this, because you have a lot more insights on the commercial. You hearing anything about any more commercial loan crisis going on? Because we heard a lot about that 2023, and it kind of died out a little bit last year. And I was thinking before this that I wonder what they're doing behind the scenes to manipulate the market so they somehow absorb and hide the commercial loan disaster. What have you, any intel on there?
Well, that is what they're doing, right? So the amount of bankruptcies that are out there on property right now are being stalled off because even the banks don't want to take this stuff back because there's very few buyers. So even a guy like me who would step in as a buyer, you can't get credit that would justify buying it under normal circumstances. So what you would have to do is say, which we do, okay, fine, we'll just pay cash for it and we'll get it up on its feet. And at that time, once it's stabilized, then we will go put 30-year debt on it. But you've got to be able to play in the cash market in order to do that. So the point of the matter is the commercial real estate market, as we speak, is imploding. It just hasn't quite hit the street in terms of hitting the press. But I've had multiple people come at me and say, would you help? Because from time to time that happens. Would you help rescue my property? Well, that's because they're still in a rescue phase because their bank doesn't want to take it back. They're bankrupt. The deal's done. It's over. It's going to be taken back. It's just that the banks are forestalling and say, listen, give me $50,000 and we'll sit still for 6 months, even though it's a $20 million property. So they're trying to use whatever cash they can get their hands on under the theory. And again, this is pure emotion. It's not based on math, right? The math says you're bankrupt. The emotion says, I'll raise $50,000 and I'll try and buy 6 months of time before the bank forecloses. What the investors don't understand is that the bank has still got the clock ticking on the debt. They're still running that debt up. So it's an exercise in futility, but the investor is being led around by the nose by the bank because the bank doesn't want to take the property back. Guaranteed, the investor will lose.
I want to listen to a couple of videos that came out from Mortgage News Daily on what happened today as well. But a couple things here. I saw a couple of comments like this that people were asking if they can fight property taxes in various states. And the reality is you can fight your property taxes in every single state. So stop asking, right? Like everyone's supposed to be using the math. Every central appraisal district is supposed to be using the math to determine your value. And so you should fight it in every single state, even the islands of Hawaii. But they're also asking,
I think he's
no,
asking,
I know. That was a separate thing. But this question is saying, Mitch, is there anything we could do to help with the property tax lawsuit? And there's a lot. You want to go ahead, Mitch?
We're at the Fort Worth Court of Appeals right now. So as far as helping with this lawsuit, I don't know what that court is going to do. We are fully prepared to take this to the U.S. Supreme Court. At that point in time, depending on what the real cost is going to be, I may reach out. But for the time being, we've done this. Everything we've done has been free. We haven't asked for 10 cents from anybody. I haven't. And I'm going to try to hold to that. It's just a question of overall cost. But in reality, the best everybody can do is to protest their own property.
Yes.
Because even I had a senior just a couple of days ago. Said, well, you know, I'm a senior. I don't have to, because I've got a 65-year cap, a 65-year-old cap on his value. So he was asking, is there something I can do? And I said, yeah, protest your value, because it's not just you, your neighbors are going to get screwed over. If you don't protest your value, the CADs will use that not only against you, because they'll simply say, well, you must have agreed that this was the value because you didn't protest it. They will use that against your neighbors. So it really is all hands on deck, and everybody has got to protest. That's what everybody can do for everybody else. And by the way, if you can ramp up the amount of protests and you can ramp up the amount of lawsuits in any school district, you can bankrupt the CAD. They don't have the horsepower to deal with it. So if you double up the current lawsuits, you can bankrupt them.
Yeah, and that's what we're trying to do, guys. Listen to what he just said. Doesn't take a lot of us to do this. Real quick, I just went over that. How do we protest? I think that's a realtor, our home to be. I don't know, could be wrong. But again, just how do you protest? Please pay attention to what I'm saying. Okay, I have a post on the Real Estate Mindset channel right here. Okay, you go to the post under my channel right here, and this is going to show you what to do next. Okay, I have a seminar also this Saturday. You guys can go to that seminar on Saturday, or you could just do those first 3 steps. I wanted to talk about this because I want to play these videos. Dang it, I lost the comment. The comments are coming up so quick. Here we go. Do you think interest rates will go down? And I want us to both talk about this, Mitch, because this is important. And then we're going to go into 2 more videos. But I've been telling people for a long time, of course, interest rates are not going to go down, and they're going to probably stay in the 7%. And the reason they're not going to go down is because during the quantitative tightening, they were trying to decrease the stimulus in the market. They needed high interest rates, quantitative tightening. They need things slowed down. So the only reason they would even lower interest rates, technically, it would be the federal funds rate, not even the 10-year treasury. But the only reason they would do that is if turmoil was happening in our economy. They would lower the federal funds rate. The Federal Reserve would lower the federal funds rate to help stimulate the economy. But that doesn't necessarily mean that residential mortgage rates are also going to go down. They're two separate things. For example, if a country goes into recession, say Japan does, or the yen trade deal, or whatever's going on in China, and they need liquidity and they sell things like that, even though they're using the treasuries for collateral to lever up their own Ponzi scheme, it could affect the 10-year treasury. And so the question, to answer your question, do I think rates are going to go down? I think that we're heading into recession, and actually already in recession. Okay, so I think that the federal funds rate will be cut. So I do think that eventually, I don't know when, it's when everyone panics, when there's more panic, I think the Federal Reserve is going to cut. As far as residential mortgage rates going down, I think you're going to have a disaster happening, and it's hard to know if residential mortgage rates are going to go down, being that how many different entities own those 10-year treasuries and how much control they have over our markets. So I think that what will happen more than likely is this. I think it'll be a little bit of a roller coaster ride. We're going to go into recession, and during the recession, I believe that interest rates, residential mortgage rates, will probably stay in the 5%, mid to high 5%. That's exactly what we need. It could go lower if there's a full-fledged depression and panic, right? And no one has any money, it could go lower. But I believe that the lowest that residential mortgage rates will get this year is in the mid 5s, personally, if that. Mitch, what about you? What do you think?
For every action, there's an equal and opposite reaction. The truth is, you don't want interest rates to go down. If interest rates go down, inflation will take off like a bat out of hell. The only thing that has kept the inflation, as bad as it is, in check is the fact that they upped the interest rates. They saw it coming. They were trying to contain the damage. Now, remember something. This is all created by the Federal Reserve, every stitch of this. So they can throttle up the interest rates and they can throttle down the interest rates, but they have failed on their mandate, which is full employment and low inflation. So they can monkey all they want. They completely missed the picture. Mom and pop only have so much money to spend. It's called median household income. And if you don't study it and you don't look at it, then you're going to make stupid ass decisions, which is exactly what they've done. They have proven why they should be closed down, why the Federal Reserve should have its doors chained. It is pure manipulation. It is pure fraud. It is pure evil. They accomplish nothing for society. They exist for the benefit of the banks. And if 60% of the banks were gone tomorrow morning, the vast majority of people wouldn't know the difference. They pick up their cash, go and put it in a surviving bank. 600 trillion worth of derivatives that nobody can see and nobody can tabulate would disappear. Good. And that the banks that were generating the fees off the paper chasing paper would disappear. Good. Didn't need them. They contributed nothing. They made nothing. They built nothing. It's paper chasing paper.
And I'm also going to say residential mortgage rates aren't even high right now. My last interest rate was 6.7% when right before I lost everything was 6.7%. People think that interest rates are high right now because the prices are so high. If prices weren't so astronomically high, ungrounded from fundamentals and kept up with median household income, then maybe we'd be okay. But interest rates are not high. It just seems that way because prices are freaking insane right now. Absolutely incredibly crazy. But people keep forgetting that. Go ahead.
It's a trade-off, right? So if you took interest rates, true available interest rates right now today, and you drove them down to 3%, it isn't going to move the needle. Why? Because the inflation would pick up the slack. In other words, it would literally invert. So you would say, well, but my payment is going to be that much less. Well, in theory, yes, except that if inflation goes up and your cost of your house goes up by 15%, then the answer is no. And that's the problem. It is all driven by the median household income. They just don't want to talk about it.
No one wants to talk about that or the debt, bonds, unfunded liabilities. Mitch, let's listen to a video real quick on what happened today, and let's see if the talking heads got this right. Let me just kind of cue this up real quick. I gotta listen. Let me get through the commercial. Oh my God, can you do that? Jeez, it's like rock and rolling over there. All right, we're gonna listen to our first video here. This is on 104% tariff on Chinese goods set to take effect at midnight. And let's try to figure out, based on the presentation and what we just talked about, are these people reporting on this a bunch of fools that just want us to spend money, or do they have some merit, right? Like Mitch said, a market is created by people with the differences of opinions. I'll say that this market is created by the person that could best manipulate people. That's the market that we're in right now. But let's listen to this. This is it's only a minute and 42 seconds. Let me tee it up. If you guys can, let me know that the audio is good, and we'll listen to this now.
104% tariff on Chinese goods goes into effect at midnight. And since that confirmation, we've seen the market trading much weaker than it had this morning. China seems ready with more retaliatory measures of its own. Let's bring in Eunice Yoon. Eunice, what's the latest?
Well, Kelly, China has refused to succumb to what it's been describing as President Trump's tariff blackmail by removing the additional 34% tariff on American goods by now. Instead, it's been messaging what could come next through two influencers, one linked to the state news agency, Xinhua, and then the other one is a nationalistic blogger. So both of them had posted identical lists of possible steps, and they are to suspend cooperation on fentanyl, ramp up tariffs on farm imports in states friendly to President Trump, ban the import of U.S. poultry, target U.S. services in China, so that's finance, law firms, consultancies, cut or ban U.S. film imports, and then to investigate U.S. companies' IP gains in China. And they were citing Ford CEO's recent praise of the EV technology by Chinese companies. So in addition to that, China has guided lower the Chinese yuan to its weakest level in 18 months. And this was a move that was seen as a signal of a possible larger devaluation in order to offset the impact of these tariffs. Kelly?
All right, Eunice, as we watch the currency, we wait for more word out of China. This has been the driver of markets. We really appreciate it tonight.
Okay, they're saying that is the driver of markets. I'm going to tee another video up real quick. What do you think about that, Mitch? Any reaction there?
Yeah. Idiots in their own ecosystem.
Is that what that was?
Yep.
All right, that's fair. Let's do another video on how China refuses to back down after Trump threatens an additional 50% tariff. And let's see what they have to say here. I got to let the commercial play. That was CNBC, so it's got to play real quick. Let's see here. Let me go back over here real quick. And
If you think about it, so they say, well, we're going to ban food imports. Are you crazy? You're going to starve people to death over this?
Oh, and the fentanyl?
The Chinese aren't going to do that. They're not going to do that to their own people because they could end up with a war. They know that. They're not stupid. So they can say, well, we're going to fight this to the end. Okay. Again, idiots without the benefit of intellect. Fight what to the end? All it takes is both sides being even. That's it.
So I got a little
5 minutes.
If they would just sit down, I guess I know what the hell, man. And then fentanyl, you really trying to bring up fentanyl like you're killing people and you're going to use that as a negotiation tactic, you sons of guns. But here's a little bit of info on the reversal. S&P 500 rebound collapse is the biggest U-turn since at least 1978. Yeah. Investors can't shake tariff jitters. I have them set up here. China refuses. Okay, so let's listen to this, Mitch, right now. I'm going to put us on mute. If you guys can, let us know if the audio is good. And let's see what they have to say now about what.
A lot of card playing. They love the whole card analogy.
What is it, bridge? What do they play?
I don't know what they're playing. All right, let's
play war.
Let's get to Eunice. Maybe she knows what card game they're all playing here. Eunice, of course, joins us from Beijing with the latest. Good morning, good night, or good evening, I should say, Eunice.
Good morning, guys. First of all, in terms of China's overall reaction, surprisingly to probably no one, the Chinese decided not to succumb to what they described as President Trump's blackmail, and they refused to remove the 34% additional tariff on American goods by today. Instead, they've been messaging through the state and social media, particularly to two influencers, one who's linked to the state news agency Xinhua, and the other one who's a nationalistic blogger, the possible next steps. So these two folks had listed out 6 measures. So these are to suspend the cooperation on fentanyl, ramp up tariffs on red state farm imports. So those are that are friendly to President Trump, ban imports of U.S. poultry, target U.S. services in China. So this includes finance, law firms, consultancies, cut or ban U.S. film imports, and then investigate U.S. firms' intellectual property gains in China. And they cited the Ford CEO recently talking up Chinese EV technology. So in addition to that, the Chinese guided the renminbi, the currency, weaker to its weakest level in 18 months. So that was really seen as a signal here that the government is potentially going to see a bigger than expected devaluation of the yuan to help offset some of the problems that could happen with a bigger tariff hit. But you guys were talking about it a little bit in conversations that I've been having with both Chinese suppliers as well as U.S. suppliers. The fact that the tariff rate now could go, as you guys are talking about, 104%, possibly 120% when you count all of it all together. They were telling me that this is prohibitive to business. One Chinese supplier said that they're already looking for other markets, that they wouldn't be able to really sell to the U.S. market. And then one U.S. company whose sources in China said that once Trump had made that announcement about the potential for another 50% tariff, he actually froze all of his shipments out of China. A part of it is because he said that he's just confused about exactly what type of price he should slap on any of his products. And then so he's worried about the uncertainty, but he's also just worried about what this could mean for his sales. He said that he would be in a position where he'd be losing on every single item that he sells. And even though he said he looked at the U.S. to potentially supply there, or set up a supply chain there, he said that it's just not realistic at this moment. So you're potentially looking at paralysis.
Eunice, the idea of retaliation against U.S.-based corporations that have a lot of business there. We've seen an investigation of DuPont, I believe something else on Illumina. Do we get a sense there may be more to come?
I mean, that's the signaling at this point, but in terms of exactly who might be the target, it's really unclear at this stage. One other thing that I want to bring up when you guys are talking about Scott Bessent, from the Chinese perspective, they do not see themselves as the ones with losing hand, because as much as China, as the U.S., China is the one who's selling to the U.S., so it looks as though China is much more vulnerable. On the other hand, it also means that the U.S. needs a lot of stuff that the Chinese actually sell, and that would include pharmaceuticals and other important things. So the leverage actually goes both ways, and the Chinese understand that.
Yeah. Eunice, thank you.
Thank you.
All righty. Mitch, you look like you're chomping at the bit right there. Go ahead and respond to that. I'm going to queue up maybe one more video if I can find anything interesting. But what do you think about that super smart lady right there? She got some good points.
Yeah, we'll bypass on that one comment, but suspension of cooperation of fentanyl. Really?
That's stupid.
Yes. And then devaluation of the yuan, as if that's going to help China and help its citizens? No, it's going to make goods and services more expensive in China. It accomplishes the exact opposite. So, like I said, no intellect whatsoever, complete nonsense, just hot air.
Okay. That's fair. I thought you were going to talk a little bit more than that. You caught me off guard there. Let's look real quick. I have to play this commercial. Take a look at the Chinese offshore yuan right here. It's going up about 5 basis points now. Very interesting. I'm going to go back to you real quick and let me just see. And we're going to listen to the next video is going to be on taking forever with these commercials. It's going to be on how mortgage rates are up to 6.75%. If you guys are on the sideline as a renter and you're dying to buy a house, just remember, you guys, most people that have a mortgage right now at 7%, their real interest is 150, and that's not counting property taxes and insurance. And what I mean by that is the amortization schedule is an absolute trap. And what we've been trying to say is one of the best things that you can do right now with your money, if you have any, most people don't have money, right? I barely have any, is pay off your mortgage. Paying off your mortgage is a great thing. So anyways, we're going to go into mortgage rates now, and we're going to see if they can provide us with some clarity on what's going on with residential mortgage rates. I'm going to mute us, Mitch, and you guys, if you can, let me know the audio is okay.
Hey, Diana Olick joining us now. Diana, let's do this as opposed to tell us what's happening right now, but also give us kind of a lesson in how the mortgage market moves when you have these kinds of rapid and violent changes in rates.
Well, it's really actually hard to tell, Brian, because we only get one read on mortgage rates per day. We get that from Mortgage News Daily. Actually, CNBC gets that every morning because Mortgage News Daily runs those morning numbers. But usually others will get that weekly rate. We get that from the Mortgage Bankers Association and from Freddie Mac, and that's kind of a general look at the whole week. But on this daily one, we've seen a lot of, day-to-day volatility, as of course we have in the stock market. So after falling last week, the average rate on the 30-year fix actually took a big leap higher this morning because, again, of those rising bond yields. It rose 15 basis points to 6.75%. But I would also note that Friday's early rate was revised higher later in the day, again, because of bond yields. So any upside to that huge stock market sell-off for mortgage rates is now erased. In the rates, at least. We're right back to that very tight range that mortgage rates have been in really for the last month and a half. But if you look and go back to the start of this year, rates were over 7%. And then they dropped sharply in February. During February, pending home sales, which are a measure of signed contracts on existing homes, so that's people out making deals when rates were dropping, they only rose 2% from January, despite a lot more inventory on the market. And they were still close to 4% lower than last February. Now, the most current data that I like to use for housing demand, though, is the weekly mortgage applications. And while they have been moving higher recently from home buyers, they're wobbling in another tight range that is still well below where we were pre-pandemic. And when mortgage rates were falling in February, mortgage demand from home buyers was also falling. Usually those go in opposite directions. So it all comes down to what I keep hearing from housing experts, which is that mortgage rates are falling, but for all the wrong reasons for home buyers, reasons that don't make consumers want to go out and make a huge purchase like a home.
Yeah, I mean, again, it has nothing at all to do with price, right? Nothing to do with price, nothing to do with income, nothing to do with debt, nothing like that. And Mitch, we're gonna start getting out of here, but I want to ask the viewers just one more thing. You guys, if you want me to pull up the MLS, okay, I'll pull up the MLS live right now. If you want me to, one more bonkers. You guys give me a bonkers below. I'm gonna go into MLS. We'll look at active listings and see if I can't find something with wedge. But that's if you guys want me to do that. Mitch, reactions to the video?
Well, nothing. Same type of nonsense. I mean, it's just you could take the interest rates down to zero. If people can't afford it, they're not buying. End of story. With regard to Mr. Johnston's comment, in the thesis document is a section, and that section asks the question, what would it take for the U.S. government to balance the budget? And it outlines the amount of percentages that things such as Medicare, Medicaid, Social Security, it touches on all of them. And that's in the document as what it would take to balance the budget, as separate from the 600 trillion worth of paper, which isn't worth doing anything but lighting it on fire. So it's a pretty interesting document. Travis will post it below the video, but it's all there.
Yes, that's right, guys. I'm going to post the document through Drive, Google Drive. So if you guys want that thesis that Mitch did, it's going to be, you guys got to be like 20 minutes after I end the live. So I'll add that, and I'll add the seminar this Saturday as well. Man, I really hope to see all you guys at that seminar. I mean, there's a couple of people that have signed up already. A few have been people I've known for a while, so I'm really excited actually about it. All right, so they want me to do a brief market analysis. Now, here's the thing. This is what a realtor should be doing. Let me remove this comment, okay? So this is what a realtor should be doing. And if you're a realtor, pay attention here, because this is what you should be doing for your client. And if you're not a realtor and you just wonder how this stuff works, this is what you should tell your realtor to do. So this is MLS. I can search the database, 20,000, 30,000 listings, and based on what I select here, it's going to give me that data. But what I always tell you guys is this is more of the emotional part. Obviously, size matters. Wait. Oh, yeah. Okay. Bedrooms matters. Location matters. All of that stuff matters. But if you just want to look for a great deal, you don't need to check any of that. You just go to price per square foot. I put $100 a square foot to $120 a square foot, and it gives me 2,195 listings. So this is how you do it. And all I do is I go to the map. I've now condensed 30,000 listings into 2,000. And so what I like to do is, and I like to zoom into areas, and I've been showing the viewers Kingwood, and I'll just look at these areas and I'll see if I find something that meets what I like, which is size and things like that. Now, one of the things I want to show you guys, so here's one right here. I wonder if this one. All right, so let's go to this one, and I want to see what the taxes are on this. Okay, so I go here. Okay, obviously there's a price cut. I mean, this is active in the market. So you don't have to listen to these talking soup morons that just say to buy and, oh, if you can afford it, just buy a house. Like, no, they don't even tell you what affordability means. They never tell you what that means, or what possibly can happen in the market if your home value goes down. If your home values go down, you're trapped in a prison. It happened to me. Either way, this listing went down about $12,000. It's been on the market for 48 days. Looks like a nice house. Okay, I mean, that's a nice house, Mitch. It's about 2,800 square feet. Okay. But when we go to the taxes now, and by the way, you can also go to archive. That tells you if they're playing tricks, if you go to archive. But I'm going to go to taxes. So it's for sale for 337. Maybe it's taxed right. I have no idea. Okay. So for sale for 337, and it's taxed at, you see guys, look at this crap. So it's assessed at 383,000, and they can't even sell it for what I just showed you. Isn't this absolutely incredible? What they're doing to us? They're freaking robbing us blind right in front of our eyes. And they're saying in 1 year it went up 16%. Home values didn't go up 16% in Houston in 2023. They went down. How could you justify that? It's a crime. Hopefully we'll be making progress. Obviously, that's what our Discord is for, which we'll be creating. But I mean, that's just a quick little thing right there, you guys. That's what your realtor should be doing. And then I would do a subdivision analysis on the property. I would find wedge. I find cash flow. I would go there. I would go around the neighborhood, make sure there's no barking dogs and things like that. But, you know, as far as am I going to buy it, as soon as I find something that both I love and the math works. And when I say math works, I want 30, 40% wedge, and I want to be able to cash flow $500. That's it. That's all I want. Problem is I can't find that. I can find the price part, but in Houston, property taxes, I just showed you property taxes and homeowners insurance through the roof. So I'm going to get everyone out of here. Mitch, do you want to say anything, any closing statements before we let them go? We've been talking for about an hour and 36 minutes, my friend.
Yeah, I'm pretty sure everybody's tired of us by now.
I know. I hope not. It happens. But anything you want to say to them before we go? Or no, you good?
If somebody's really hot to trot and they want to buy a house, what would you pay for that house if it turns out that your property taxes would cost you an extra $15,000 a year? And that's happening. So why would you want to enter a market and have that possibility occur to you? And what would you do about it? And that really is the one reason why every single property owner, doesn't matter whether you're commercial or single family, should be protesting your values.
Yes.
The ultimate conclusion is to sound the alarm and bankrupt the central appraisal districts. Simply double up the protests, double up the lawsuits. They're done.
Absolutely, man. And again, you guys, the seminar, the course, I got seminars, I got courses, I got posts. I don't know what else I could do to help you guys help yourself, right? But I want you to, maybe I'll lead by example. I plan on going to my own ARB hearing. I'm going to film it. If you're online, I'm bringing Jason. But I'm going to get out of here. Scrog, I love you, man. Scrog is posting the links in the comment section. That's my buddy. Scrog is going to be a moderator. Email me again, Scrog, or Tom, rather. you guys, I appreciate you. We're going to get out of here. Once again, share the video, comment on the video. We love you guys. Be careful. And if you guys are out there investing in yourselves, you guys already know we wish you luck. And don't forget, you guys, we hope you win.